Okay, next up we have a little short video here about the Canada housing crisis that we are currently going through. Hopefully you find this informative. Be prepared, be aware, and don't believe everything you see. Research it for yourself. I'm just saying, be aware of what's going on, and let's get into it.
Debt and unaffordable housing. You see, in places like Vancouver, British Columbia, it's not uncommon to see homes like this 3-bedroom 1949 bungalow going for $5.5 million. Albeit that's Canadian. It's only $4.1 million.
If you live in Canada, you understand.
But as property prices have risen in the country,
it's insane
incomes have
here.
not kept pace, leading Canadian households to become some of the most indebted in the world, as homebuyers have made up the difference between their incomes and house prices using debt. Now, interest rates are on the rise, home prices are down 12% from their peak, and people are starting to wonder if Canada's housing market is in a soon-to-pop bubble. During the 2008 financial crisis, the US housing market was pummeled. Rising interest rates combined with unsustainable lending practices caused mortgage delinquencies to surge and home prices to lose a fifth of their value, contributing to one of the worst economic ruts in US history.
This is the point in time when I started waking up
things were a lot
to the reality of the economy that we live in.
The US, home prices in the country fell just 9.2% from their peak in 2008 to their trough in 2009. And while it took nearly a decade for US properties to return to their previous high, Canadian properties recovered all of their lost ground within 2 years. Many attributed this resilience to Canada's sound mortgage lending practices and robust banking industry. Because while America's real estate slump did have the silver lining of making properties more affordable for a period of time, Canadian properties never experienced a similar correction. Even after accounting for the recent slump from their pandemic high in 2022, Canadian home prices have doubled in the last decade.
In 2008, majority of the world's housing prices corrected back down to a normal level where people can afford to buy it again. But it didn't really happen in Canada. It went down a little bit, but then within 2 years, we were back up to what we were, all-time highs.
Now, it's estimated that homeowners require a minimum income of $180,000 to afford the average property price
$180,000 income to afford a home now.
Median family income sits at roughly $121,000, or 33% below this amount. But that's at the aggregate level. Things are craziest when you dive into Toronto, Ontario, and Vancouver, British Columbia, two of the top 3 most populous cities in Canada, with roughly a quarter of the population between them. Average prices in these 2 cities have reached $1.1 and $1.2 million, Toronto and Vancouver respectively. That's roughly 9 times the average economic family's total income for both cities. Between 2016 and 2021, Canada had double the population growth of every other G7 country at 5.2%, thanks primarily to immigration, the vast majority of which was to the country's larger cities. And in fact, Canada saw its population surge 2.7% last year alone, welcoming over 1 million people for the first time in its history. But while population growth obviously plays an important role when it comes to real estate, immigration has played an important role in supporting the economy and Canada's aging population. Not to mention, there are many cities in the US with a higher population density than Toronto that don't struggle with sky-high property prices. So, what's causing Canada's market to stand out in terms of affordability? Well, simply put, one of the key differentiators here is a lack of supply. Canada has the lowest housing supply per capita out of the G7 nations at 424 units per 1,000 people, with the Federal Housing Agency estimating
like almost
that Canada
50%.
would need 5.8 million new homes to restore affordability by 2030. One expert estimates it takes 8 to 10 years to go from acquiring an undeveloped piece of land to building a property in Toronto. And zoning restrictions imposed by municipalities across the country have made the densification of land incredibly difficult. In Toronto, for example, the majority of land only allows for single-family developments, with mid to high-rise buildings only typically being permitted in limited locations, despite it being the most populated city in the country of Canada. And this imbalance of supply of homes with actual demand for property has only been exacerbated by the rock-bottom interest rates of the last 15 years or so. Following the 2008 financial crisis, many central banks for developed countries, including Canada, dropped their policy rates to near zero to try and bolster lending activity. This caused mortgages, the loans for buying properties, to become dirt cheap, while making fixed income investments, which now paid investors a lower yield, a lot less attractive. As a result, many investors took their money and put it into real estate, given that it could be bought with cheap debt, rented out for extra income, and had a track record for actually appreciating over time. Now, this factor is obviously not unique to Canada. We've seen similar asset price inflation in the US thanks to its low interest rates. But given how long it's been since Canada has experienced a real estate correction, prices were already starting off with a relatively high base. And with Canada's particularly resilient reputation, investors flooded in. In 2020, it was estimated that 1/5 of all homes in British Columbia, Ontario, New Brunswick, and Nova Scotia were investor-owned, while non-resident ownership is as high as 14.9% in the student-centric subdivisions of Vancouver. Across the province of British Columbia, the rate is much lower at 7% of condominium apartments and 2.5% of houses. And while units not occupied by their usual residents sits at roughly 7% for both Toronto and Vancouver, some of which may be vacant, this figure can also include certain types of student housing or other forms of housing which, by definition, are not occupied by usual residents, with there being mixed figures and debate on how many properties in Canada are truly left vacant by investors and the like. So while foreign investors have had an influence on pocket regions of Canada, instead, it's truly the combination of all these variables, the policies encouraging high demand and speculation, without a subsequent follow-up in supply. And as Canadians have tried to keep pace, something else has crept up to pretty concerning levels.
Debt.
As prices have outpaced savings, buyers have borrowed the difference, contributing to record levels of debt in the country. Now, with the Bank of Canada recently hiking its central bank policy rate from 0.25% to 5% to combat inflation, we have seen it
5%
cooling
now.
down in the space recently, with home prices and debt levels in the country both pulling back. But in the near term, these same rate hikes have actually exacerbated the affordability problem. After all, the rate you pay on a mortgage is a determining factor in the size of your monthly payment. With the Bank of Canada hiking its policy rate so drastically, we've seen mortgage payments skyrocket across the country. If you took out a $500,000 25-year mortgage at the typical 1% variable rate available to you on January 2022, your mortgage payment at the now 6% rate would be jumping from roughly $1,890 a month to $3,222 a month within the span of 9 months. And this isn't just a hypothetical possibility.
Like, who
News
is
outlets have already
going to
started
buy
sharing
that?
stories about Canadians who were
Who's
convinced
gonna get
they were making
themselves
a
into that
fortune-building
fucking kind of
investment for their
debt?
future, and now face the possibility of financial ruin as a result of their skyrocketing monthly payments. Now you might be thinking, sure, that sucks for variable rate borrowers, but exactly how many home buyers opted for a variable rate? Well, in the last few years, the majority, actually.
Yep, that's
You
what
see,
I
when
heard.
rates were at their rock bottom levels during the pandemic, variable
a
rates
lot
on
of
mortgages
people
were actually offered at a substantial
variable
discount
rate
to
mortgages.
fixed rate mortgages, with banks wanting to pass along the interest rate risk of these loans. And since homebuyers had spent a decade in a low interest rate environment, many assumed low rates would continue, which has led to 1/3 of mortgages in Canada to be variable rate. But wait, there's more. In Canada, fixed rate mortgages aren't really fixed rate either. Rates are only locked in for a period of typically 5 years or less, after which the mortgage rate resets based on the market rate of the time. That means that over the next 5 years, virtually every Canadian with a mortgage will see a financial impact from these higher rates.
Yeah,
And
do
while that's
homeowners
scary
not
enough,
think of
there's
that?
one final quirk about Canadian mortgages that really highlights how devastating this can be for Canadian households. With the exceptions of Saskatchewan and Alberta, mortgages in Canada are recourse loans. This means that if you don't pay off your mortgage in full, lenders can go after your personal assets to make up the difference, even if you relinquish your house. If prices continue to fall, Canadians who can't afford their high interest payments may not be able to recover the amount from selling their house to pay off their mortgage, which won't decline in step, meaning they'll still be making payments on that difference,
Wow.
even after losing all the equity from their prior payments. If prices continue to fall, Canadians who can't afford their high interest payments may not be able to recover the amount from selling their house to pay off their mortgage, which won't decline in step, meaning they'll still be making payments on that difference, even after losing all the equity from their prior payment.
You can sell your house in Toronto for $1 million and buy a house in Alberta and still have extra money to invest or start a business. So those are one of the options that I know a few people have taken.
It gets worse, because some Canadians are actually seeing the balance of their mortgage increase. 3/4 of variable rate mortgages in Canada are fixed payment mortgages, meaning that the borrower makes the same dollar payment each month, regardless of what interest rates actually are. Fluctuating rates still impact the policy, but they simply change how much of the payment goes towards the principal versus the interest expense. If rates go down, the mortgage will actually be paid off faster. But if they go up, a larger portion of the payment
You're
will
just
simply be
paying
going
off the
towards
interest.
that interest expense instead of paying down the principal. And when they go up as drastically as they did in 2022, they can reach what's called their trigger rate, where the fixed payment is entirely taken up by
Trigger
interest
rate?
and home buyers are no longer paying down their mortgage balance. And when rates go past this point, borrowers can either increase their payments, pay off a chunk of their
Wow.
principal, or if none of those options are available, apply the interest back to the principal, something called a negative amortization mortgage. And while this might sound like an impossible nightmare scenario, we're unfortunately already seeing it happen. Desjardins estimated back in May that over 3/4 of variable rate fixed payment mortgages had surpassed their trigger rate, a figure that's surely
Wow.
higher now. given the
3/4.
rate hikes we've
That
seen.
means everyone's
and
paying
More recently, 3 of Canada's big 6 Canadian banks
just
disclosed
interest.
that 20% of their mortgage portfolios consisted of negative amortization loans. So, yeah, that's how crazy things have gotten in Canada. But it does all beg the question: why haven't things crashed yet? Many Canadians are trying to tough out the turbulence in hopes that things will moderate. You see, during the pandemic, Canadians actually built up sizable cash savings, with checkable and at-notice deposits rising 40% between 2019 and 2022. This has given Canadians a bit of a buffer to make these higher mortgage payments. There's also the fact that when it comes to fixed rate mortgages and even some of those variable rate ones, those payments obviously might delay a delinquency by not changing immediately. And while you can blame those falling behind on mortgage payments for buying into a hot market when they couldn't afford the surge in rates, most people aren't real estate experts, and not many people could have predicted the surge of rates we've seen. And given how much of real estate is commission-based, even those in the industry are unfortunately more incentivized to focus on generating sales than ensuring budget feasibility when it comes to buying a house, with many buyers being told that so long as you could get approved for a mortgage, it was worth buying a property, regardless of your situation.
So that was just a little video on the Canadian housing crisis that we are currently experiencing. And I'm just documenting the next 2 years of the changes that we are going to see. And if you're in the same boat as me, wait a year and look for houses then. Don't be trying to buy a house right now. Interest rates are crazy, and there's no way most of these houses are worth what they're selling it for. Just be aware, do your own research, comment down below, and we'll see you next time.